Every time silver or gold rises sharply, the market's familiar reflex is always the same. Is this excessive? Should profits be taken? Are the indicators overbought? Those questions sound reasonable, but they are only valid in a world where money is still trustworthy. The problem is, we no longer live in that world. Historically, every major bull cycle in precious metals has never begun with consensus. On the contrary, it has always started with skepticism, ridicule, and corrections that convinced the majority that it's all over. In 1979, when gold surpassed $300, the financial community also believed it was a bubble. In 2010, when gold broke through $1,000, the argument that it was already too high was repeated once again. But what do these moments have in common? No one was willing to ask, why did the monetary system force gold to rise to those levels in the first place? Comparing these periods reveals a clear contrast. In 1980, the United States faced double-digit inflation, and confidence in the USD collapsed after years of money printing to finance war and deficits. In 2011, the world was shaken by a debt crisis, quantitative easing flooded the system, and central bank balance sheets ballooned. And today, we are witnessing a more complex version of both. Inflation has not been fully resolved. Public debt is at historic levels, and confidence in government bonds, the pillar of the modern financial system, is beginning to crack. In this context, a sharp rise in silver is not a sign that silver has become expensive, but a sign that fiat money is becoming cheaper faster than expected. This is the core distinction that many investors overlook. They look at the price of silver in nominal terms, while the real issue lies in the unit of measurement itself. History reveals an interesting paradox. When the system is stable, precious metals are dismissed as dead assets. When the system becomes imbalanced, those very non-yielding assets become the most honest measure of risk. In other words, silver and gold do not create crises. They merely reflect them earlier than other assets. Therefore, the question, how high will silver go, is actually secondary. The more important and more uncomfortable question is, what is happening to the monetary system that once again forces precious metals to assume a warning role? Backend index pointing right. If you are interested in analyses that go straight to the core of money, bonds, and precious metals, don't forget to subscribe to the channel so you don't miss the next parts of this analytical series. In a normal market, a correction is a sign of exhaustion. But in a system shift cycle, a correction is a sign of selection. History consistently shows a ruthless rule. Moves of historical magnitude never unfold smoothly. They must be painful enough to convince the majority that they are wrong, chaotic enough to generate doubt, and abrupt enough to force a change in the structure of ownership. The jiggle in the middle that silver has just experienced fits this pattern precisely. Look back at 1979 to 1980. Before silver went vertical, the market endured multiple drops of 20 to 30% within short periods. Speculators at the time believed that the top was in, while in reality, this was the phase in which silver was shaken out of weak hands and transferred to those who understood the monetary backdrop. The result was that just months later, silver prices multiplied, while early sellers were left watching from the sidelines. The 2010 to 2011 period followed the same script. Silver did not rise in a straight line. Instead, it produced repeated sharp declines that shattered every traditional technical indicator. Those relying entirely on RSI, MACD, or the concept of overbought concluded that risk had become excessive. But the problem was this: those indicators were designed for stable markets, not for phases of monetary repricing. The key difference between a normal correction and a jiggle in the middle lies in intent. A normal correction aims to relieve price pressure. A shakeout during an asset shift cycle aims to eliminate false beliefs, specifically, the belief that the market will behave the same way it did in the past. At the present moment, silver's sharp decline has accomplished exactly one thing. It has caused investors to doubt their own thesis. New participants panic, leveraged players are forced to exit, and those focused solely on short-term price action believe that it's all over. But when viewed through a historical lens, this is not a signal of an ending. It is a signal of preparation for a more aggressive phase ahead. The paradox is this: a trend only becomes dangerous when it feels too comfortable. When everyone believes When prices only move higher and no shakeouts occur, that is when risk truly accumulates. By contrast, widespread doubt following a violent correction is precisely the condition required for a long-term trend to continue. The jiggle in the middle, therefore, is not a test of the market. It is a psychological exam. It does not measure how good your technical analysis is. It measures how deeply you understand the monetary context. And history consistently favors those who understand one simple truth. In major repricing cycles, patience matters more than intelligence. During calm periods, silver is always categorized as a risk asset, highly volatile, relatively small in market size, and easily subject to speculation. But history reveals a counterintuitive truth. Silver only becomes dangerous when the financial system itself begins to destabilize. At that point, it is not silver that has become riskier. Everything else has become riskier than silver. Look back at the key turning points. Prior to 1980, silver was viewed as an outdated industrial metal. But when U.S. inflation spiraled out of control and confidence in the dollar collapsed, silver became the most sensitive barometer of stress. It rose faster than gold, fluctuated more violently, and precisely because of that, exposed the truth the market preferred to avoid. The monetary system was failing at its core function of preserving purchasing power. The same pattern emerged in 2010 to 2011. While gold responded in a more orderly fashion, silver surged like a shockwave. Not because silver was more popular, but because it reacted earlier to stress within the paper asset system. It functioned like the canary in the coal mine, not the source of danger, but the first alarm. Comparing silver with traditional safe assets reveals a stark contrast. Government bonds are considered risk-free because they are backed by sovereign credibility. But when public debt grows faster than economic output, and when central banks must buy their own government's bonds simply to prevent market collapse, the real question becomes, where does risk truly reside? In a metal that owes no one anything or in assets that exist entirely on promises of repayment? Silver pays no yield, that is true. But in an environment where nominal yields are eroded by inflation and issuer credit risk becomes increasingly visible, the absence of yield no longer means a lack of appeal. History shows that whenever the system enters a phase of monetary repricing, the most important criterion is no longer how much yield, but who ultimately bears the risk. The key point is this: silver is not a risk-off asset in the conventional sense. It is a durability test for the system itself. When everything functions smoothly, silver is ignored. But when cracks begin to form, silver reacts first, forcefully, quickly, and uncomfortably. That discomfort leads many to mistake silver for the problem, when in reality it is merely reflecting the problems embedded in other assets. In other words, when silver becomes violently volatile, the proper question is not, what is silver doing? But rather, what system is under such pressure that silver must respond this way? And history shows that every time silver has played the role of a stress test, the final outcome has rarely favored paper money. In financial history, an asset can only have a single price when the market believes that everyone is trading the same thing. When the same ounce of silver is priced tens of dollars higher in Shanghai than in the West, this is no longer a story of arbitrage or a short-term anomaly. It is a signal that the market has split into two. Let us reverse the question. If silver were just a commodity, why are buyers in Asia willing to pay a significantly higher price for physical silver, while Western derivatives markets continue to trade at much lower levels? History shows that whenever such a gap appears, the problem is not silver itself, but the definition of price. A comparison with the past reveals a familiar pattern. Before 1971, the U.S. dollar was pegged to gold, and the price of gold was an administrative figure. But the moment free markets began to doubt the convertibility of the dollar, gold prices in black markets diverged from official prices. That gap was not a technical glitch. It was a warning flag signaling the collapse of the old pricing mechanism. What is happening to silver today is fundamentally similar. The West prices silver primarily through paper contracts, where liquidity is abundant but delivery obligations are deferred, rolled forward, or avoided. In contrast, in Asia, particularly in China, silver is viewed as a strategic input for solar energy, electrification, AI, and supply chains that break without it. There, price does not reflect expectations, but urgency. The key point is this: when demand becomes existential, price is no longer a financial number, but the cost of keeping a system running. History has seen this before with oil during the energy shocks of the 1970s. Oil prices did not rise because of speculation, but because nations understood that without oil, their economies would be paralyzed. Silver today, at the intersection of industry and monetary stress, is moving closer to that role. And when two prices coexist, arbitrage is no longer a magic wand. Physical silver does not flow back to balance prices because it is being retained as a strategic asset, not a trading vehicle. This is the moment when the market delivers a cold message. Screen prices no longer represent real-world access to the asset. In other words, the Shanghai West price gap is not an opportunity, it is a warning. It signals that the unified pricing mechanism, the foundation of global markets for decades, is cracking. And when that happens, history shows that the party that suffers is not the tangible asset, but the structures built on the belief that paper can always be converted into reality when needed. Every major financial cycle ends in the same way. Assets once considered self-evident suddenly become fragile, not because they have deteriorated, but because the monetary backdrop has shifted. What is happening today with silver and gold is not a conventional commodities bull market. It is a reversal of an asset order that has lasted more than 40 years. Look back at the period from 1980 to 2020. This was the golden age of bonds and equities. Interest rates declined continuously, debt could be refinanced cheaply, and every crisis was addressed by cutting rates further and injecting more liquidity. In that environment, precious metals were relics of the past. No yield, no dividends, no growth narrative. But history also shows that whenever interest rates hit historic lows and debt exceeds the system's tolerance, that cycle ends. The 1970s are the classic example. Equities stagnated, bonds suffered heavy losses due to inflation, and gold and silver entered a decade that redefined their monetary roles. Not because they were better, but because the paper asset system no longer fit the new monetary reality. The same pattern is repeating today, but on a larger scale. Public debt is no longer merely high, it is structural. Interest rates cannot return to their old lows without reigniting inflation, yet keeping them elevated chokes growth and strains the bond market. This is the trap every major asset rotation cycle requires in order to ignite. In this context, the fact that commodities across the board are breaking long-term bases, from oil and wheat to metals, is not a coincidence. It signals that capital is moving away from assets built on promises and returning to assets grounded in physical reality. Silver and gold are simply the clearest indicators because they sit at the intersection of money and commodities. The contrast here is unmistakable. Bonds represent trust in the future ability of the issuer. Silver and gold represent value that requires no promise. When confidence in the future becomes fragile, capital naturally flows toward what does not require that trust. This is not emotion. It is behavior repeated across centuries of financial history. The most important point of this section is this: silver and gold do not need to become stars for an asset class rotation to occur. It is enough that equities and bonds no longer fulfill their traditional role as stores of value. Once that happens, precious metals are automatically pushed to the front line. And once an asset class rotation has begun, history shows that it does not reverse simply because of a few quarters of volatility. Every major surge in gold is accompanied by a familiar mistake. The market tries to assign gold a fair value. But history shows that gold has never behaved like equities or ordinary commodities. Gold does not need to be cheap to rise, nor does it need to be expensive to stop. What determines gold's movement has always lain outside gold itself. Look back to 1933, when the United States raised the price of gold from $20.67 to $35 per ounce. No one asked, did gold deserve that price? The right question at that moment was, how much value had the U.S. dollar lost to force the government to do this? Gold did not change, the measuring stick did. The same was true in 1980. Gold reached its peak not because jewelry or industrial demand exploded, but because inflation shattered confidence in paper money. Then in 2011, when gold surpassed $1,900, the story repeated in another form. Central bank balance sheets ballooned, public debt piled up, and the market realized that stability was being purchased through money printing. What do these periods have in common? Gold does not speak about future growth. Gold speaks about present distortions. It measures the gap between nominal value and real value, between promises and the ability to fulfill those promises. When that gap widens, gold rises, not to make anyone rich, but to expose the problem. Comparing gold with silver makes this nature even clearer. Silver reacts quickly, violently, and controversially because it is smaller and more volatile. Gold is the opposite, slow, heavy, but unforgiving. When gold moves, it is often a signal that distortions have exceeded the point where they can be concealed by short-term policy. For this reason, trying to set price targets for gold often backfires. In past cycles, gold did not stop because it reached a target, but because the system temporarily restored confidence, usually through extreme measures such as aggressive monetary tightening, debt restructuring, or a reordering of the financial system. In the current context, the question, how high can gold go, is essentially secondary. The primary question should be, how can the system repair its distortions, and for how long? As long as the answer remains unclear, gold continues to have a role, not as an attractive investment, but as an honest measure that the market cannot ignore. At this stage of the cycle, the question, should I buy silver or gold, has already come too late. History shows that when the majority begins asking that question, the old asset order has fractured deeply enough that it cannot return to its original state. The real issue does not lie in the decision to buy or sell, but in the foundational belief that each portfolio is betting on. Look back at the key turning points. Before 1971, investors believed in the convertibility of the U.S. dollar. After 1971, that belief vanished, and gold entered a decade of repricing. Before 2008, markets believed that bonds and complex financial structures were safe. After 2008, that belief had to be patched up with newly printed money. Each time, it was not the assets that changed, but the belief system itself. The danger of the present moment is this: belief no longer has a place to transition smoothly. Government bonds, once the ultimate safe haven, now face interest rate risk, inflation risk, and credit risk simultaneously. Equities depend on low capital costs, while those costs cannot return to their former levels. In this context, silver and gold do not need to win. It is enough that other assets can no longer fulfill their old roles. History also teaches another uncomfortable lesson. Major repricing phases almost always cause people to react at the wrong time. Most exit too early out of fear of volatility, or enter too late out of fear of missing out. But at a deeper level, both behaviors stem from the same root cause, not understanding which structure their confidence is actually placed in. If silver and gold are right, that does not mean they are good. It simply means that fiat money is gradually losing its function as a store of value. Promise-based assets are being forced by the market to accept higher discounts. And the financial system is entering a phase where it must speak honestly about what it can and cannot guarantee. Therefore, the final question of this analysis is not meant to prompt action, but to compel reflection. Is your portfolio built on the assumption that the future will resemble the past, or is it preparing for the possibility that the past will no longer repeat itself? In every major cycle, the winners are not those who predict prices most accurately, but those who place their trust in the right structures. And financial history, despite changing forms, has always remained faithful to that rule. At this point, I believe you now understand how capital flows actually operate. Movements in the value of gold and silver always have causes, and the instability of the economy is presenting challenges at the macro level. Please continue to follow the channel, and don't forget to subscribe and leave a comment on this video to help spread its reach to more people. Thank you very much.